There's been a lot of interest in silver recently and a lot of buying of silver, both the physical metal but also exchange traded products linked to the price of silver. So why is that happening? Is it because of something that's been said on Wall Street Bets, or is it because the price of silver is trading below its fair value? So in this video we'll look at that. And remember, if you do want to learn more about investing, a great way of doing that is to sign up for our free weekly market roundup. You'll find a link to do that in the description below me and beside me. So now let's look at the price of silver in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So let's start off talking about what's been said on Wall Street Bets, which is the Reddit subgroup. In fact, there aren't that many comments about silver there, and many of them have actually been removed by the moderators. So here's one which says, this is going to be the biggest short squeeze in the world. Silver's going to go from $25 to $1,000, which is, let's face it, quite unlikely. And that's been removed by the moderators. And some of the comments on Wall Street Bets actually suggest that this is some kind of plan in order to detract from their main stock play, which is GameStop. And in fact, Wall Street Bets moderators have a Twitter account which has a blue tick, and that says that they've seen a lot of commentary about Reddit traders and silver, but only 3% of the mentions of tickers on Wall Street Bets were about silver. But the interesting thing is many people are buying the stocks which they see tipped on Wall Street Bets. They don't have to be active participants on the news group. And in fact, a lot of media are reporting what's being tipped in Wall Street Bets. So even though there weren't many comments about it, lots of people I suspect have been buying silver because they expect this short squeeze is going to be successful and push up the price of silver. I'd say the most interesting article I've found on silver on Wall Street Bets has been this one, which was tagged as due diligence. That's what the DD stands for. And it makes many interesting points about the price of silver, but I think some of them kind of miss the mark. And in particular, there's no emotion behind silver. While people might want GameStop stock to do well because it's a company that sells video games and perhaps they think the stock's been unfairly shorted, it's very difficult to get emotion behind the price of silver. I mean, nobody feels sorry for silver bars. So instead, they're trying to get emotion into this trade by saying that JP Morgan has lots of short positions in silver, a fact which I think is unsubstantiated. So instead of trying to pump up the value of a loss-making stock, which is, let's face it, what GameStop is, they're trying to pump up the price of a metal where they think there are technical reasons why there could be a limited supply of silver and they could construct a short squeeze. And that begs the question, what is a short squeeze? To understand that, we have to understand what we mean by a short trade. So when you think about making a capital gain in investment, the obvious way to do that is to buy low and sell high. But you don't have to do it in that order. And that would be typically what happens for a value investor. In other words, you see a stock which looks as if it's priced below its fair price, so you buy it in the hopes that the price will go up. But what happens if there's a company which you think is overpriced? In other words, the price is too high given its fundamentals. Well, can you sell something you don't own? Yes, in fact you can. And that's what you do with a short trade. You reverse the order of selling high first and then buying back low. To see the actual mechanics of that short trade, we've got two people here. We've got John Long Silver, who wants to have a long silver position because presumably John thinks the price is going to go up. But then we've also got Simon Short Silver here, who thinks the price is going to go down because silver is overpriced. So the way this happens is that Simon Short Silver borrows this bar of silver from John Long Silver, and that borrowing happens for some fixed agreed period of time. Eventually Simon's going to return a silver bar to John Long Silver. Once Simon receives his bar of silver, he sells it into the market. So let's say the price is $50. Now while he holds that bar of silver, Simon Short Silver will pay some kind of loan cost, which is the borrow cost, to John Long Silver. The income isn't much, but it's what creates the incentive to lend out your assets. At the end of the agreed period, Simon will then close out his short position. He does this by buying back a silver bar at the current market price, which in this case is $30. So Simon sold silver for $50 and he's bought it back at $30, which gave him a $20 profit, but he's also had to pay $1 in borrow costs. And then the final step is that he returns that bar of silver to John Long Silver. Now, if you're shorting an exchange traded product, all of this stuff works in exactly the same way. We'd borrow some of this SLV exchange traded product and then we'd sell it into the market and buy it back at a lower price, hopefully. And the actual borrow fee for the SLV exchange traded product is very low, just 0.27%. So that was a short trade. What do we mean by a short squeeze? A short squeeze might happen if the price of the thing which is being shorted actually goes up. And then Simon Short Silver could be facing potentially very large losses. And that may force him to close out the short earlier than expected. So he still has to pay the borrow cost, whatever happens to the price of silver. So he's going to lose that dollar. But then say the price of silver goes up to $70. In that case, he'd have to buy it back at that higher price. Then he'd be facing a $20 capital loss, and he'd still have to pay that $1 borrow cost. And just as before, he'd return the silver to John Long Silver. Now, if there are lots of people who are short the market and the price goes up, that often forces many of them to close out their positions at the same time. That increases the amount of buying as they have to buy back in the market at the higher price, and it pushes the price up further. So the nature of many of these trades on Wall Street Bets has been to try and force up the price and to force the people who are short out of the market. So how can we actually work out whether silver's trading at its fair price? Here's the price of silver over the last 25 years or so, and you can see that the price action is very volatile, but what's really noticeable is this big spike in the price of silver just after the global financial crisis. Now, two of the primary drivers of the price of silver are the trade-weighted dollar, so that's what you can see in this top panel, and that's kind of obvious because silver and gold and other commodities are priced in dollars, so if the dollar's weak, that pushes up the price of silver and gold. And in this lower panel, you can see US real interest rates. So that's the yield you get on an inflation index security in the United States. Now, both silver and gold are wasting assets, which means they give you no income. So when there is a very safe income providing asset like a US Treasury, which is giving you a very high income, that's particularly toxic for these assets. Now, what we've seen in 2020 is a very rapid fall in the price of the dollar, and for a longer period of time we've seen real interest rates in the United States falling very sharply. Now, both of those push up the price of silver and gold. And if you are a member of our Patreon community, then you do get access to a very simple model we've created for the fair price of silver and gold, which is based on those two inputs, but also CPI inflation in the United States. Now, the model is here in blue, and the actual price of silver over this 25-year period is in red. And when I made this video, the actual price of silver was very close to the model's fair price. Now, bear in mind, this is a really simple model, and I wouldn't trade off the back of it. It just gives you a rough idea of where silver and gold should be. And if you do want access to that model and all the other goodies you get as a Patreon community member, it's very easy to do that. You'll see a link above me which you can click on to find out more about our membership. There's lots of video content, but also some tools and explainers which are only available to members. The ultimate measure of whether this short squeeze has been successful is how much money is flowing into some of these exchange traded products. And on just one day, there were huge inflows into the SLV exchange traded product. In fact, that was a record one-day inflow for that fund. So even if this inflow doesn't come directly from people on Wall Street Bets, it comes from people who've bought into the idea published on Wall Street Bets. And to place that in some kind of historical context, these are the quarterly flows into this exchange traded product, SLV, going back over a period of 10 years. And in fact, in the recovery period just after the March sell-off in 2020, there were larger flows into this product. So far this quarter, although we have seen very large inflows over the last few days, the total inflow has only been about $1 billion. So who is actually short silver at the moment? Here's an article from The Guardian which was published in 2010, so this is a decade ago, saying that JP Morgan was short silver. And if you wanted to crash the bank, go out and buy silver. So this is a meme which has been out there for a very long time. And although I looked, I couldn't find any evidence to show that JP Morgan is actually short silver. The fact is that many investment banks are not allowed to take very large directional positions in any stocks or any commodities because that's not what they do anymore. They make money on flow, on the difference between the buying price and the selling price for commodities and stocks. So by increasing the amount of trading in these commodities, but also the exchange traded products, this is directly putting money into the pockets of investment banks, which is the exact opposite of what that message on Wall Street Bets was setting out to accomplish. And in fact, speculative positions on futures are published on a regular basis. And according to that data, money managers, that's including investment banks, have been net long on silver since mid-2019, not short. And a short squeeze would actually help those positions and make greater profits for those money managers. And if you look at the actual contract specifications on the CME Group website, you can see that description here. You can see that if you were short one of these contracts and it ran all the way to expiry, then you would have to deliver a huge amount of silver, 5,000 troy ounces, and only people with very high net wealth could afford to do that. But what happens in most cases is people simply close out the futures position before the expiry date. And in fact, if you go for any mini silver futures contract, then those are financially settled, which means that you never have to take delivery of physical silver or provide physical silver when the expiry of the contract is reached. The ultimate question is whether this short squeeze is going to succeed, and there are a number of reasons why that's unlikely. Unlike GameStop, which is a small company which operates just in the US, participants in this market come from all over the globe. And even if we look at just one of these exchange-traded products, you can see the size of these holdings is very large. So you can see Morgan Stanley holds a $216 million position, and there are comparable very large positions held by many of the other investment banks. And notice these are all long positions, which means they stand to benefit if the price of silver increases. But iShares Silver Trust is simply one of many exchange-traded products which are linked to silver. It's by far the largest, with about 15 billion in assets as I make this video, but there are many ways that an investment bank could lay off its risk in this market. But also I think it's unlikely that JP Morgan or any other investment bank has a very large directional position one way or the other for silver. Now, historically, there have been other people that tried to create a squeeze in silver. There was a famous case with the Hunt brothers, one of whom died in 2014. Here's their obituary in the FT. But in fact, this endeavor was a failure, and it sent the Hunt brothers into bankruptcy. In fact, in 1980, the price of silver fell by 80%, which is what triggered that bankruptcy. And consequently, the Hunt brothers were sanctioned by the SEC for market manipulation. What's less well known is that Warren Buffett also had a nasty run-in with silver in 1998. And when the price of silver consequently fell by 40%, that gave him the worst performance he's ever had with Berkshire Hathaway. So I think it's unlikely that Wall Street Bets per se will be able to construct this short squeeze in silver or to keep the price of silver elevated for any lengthy period of time. So if you found that video useful and you want to support us, you can now do that directly via YouTube. There should be a join button underneath the video and there should be a link above me. And if you do that, you get a beautifully designed icon next to your name, and then we'll know you're one of our supporters. And we'll try and preferentially answer your comments, but also your questions when we do a YouTube live. And, as always, thank you for listening.